Participants, welcome to today's webinar on Market Insight for Fixed Income, where we discuss key updates related to economy, debt market, and our outlook. We had MPC meeting on Friday, wherein MPC committee kept the policy rate unchanged as expected by market participants. However, cut the CRR by 50 bips to 4% to infuse liquidity in the system. I am Sonal Mittal, product specialist at UTI, and I am joined by our head of fixed income, Mr. Anurag Mittal, to share his insights, perspectives, and outlook. Post update from Anurag, we will open the webinar for question and answers. You can keep posting your questions anytime during the webinar on the link provided to you. Without further ado, I will now hand over to Anurag. Over to you.
Thanks, Sonal, and good day, everyone. And thanks a lot for joining in for UTI Fixed Income Market Insight for the month of December 2024. So we'll be discussing key updates from November, which have a bearing on future market trajectory. And we'll also be sharing our assessment of the RBI policy, which took place on 6th of December. So moving on. So first we'll discuss the global trends as major global cues also have an impact on central banking as well as the growth and inflation dynamics. So as we can see, the global economy from a perspective of growth has been sustaining quite well. If we look at services PMI, that's been above 50, which shows an expansion for consecutive 22 months. So it's been on an uptrend after the COVID decline consistently since 2022. While there have been slight moderations, but broadly it has been on the upswing. If you look at the manufacturing side as well, it took a sharp or a dip in the first half of 2024. But as we can see from the chart, it's been rising steadily. And for the first time now in last about 6-8 odd months, it's now close to 50, which signifies a neutral expansion. One of the reasons is, again, strong economic activity seen in the US, in the emerging markets, and also China. So as we recall, what we had discussed in last webinar as well, China had unveiled reasonably high monetary as well as fiscal stimulus in September, which kick-started some manufacturing activity back in China, as well as had a knock-on impact on some other emerging markets. So currently, both manufacturing as well as services look quite healthy and quite sustainable in the near to medium term. One of the key concerns which have been raised by market participants and analysts that what happens after the change in US administration. So as we know, in November of this year, we had the US elections. And while the results of the election were quite, I would say, even till the last minute, but the kind of strong mandate that the new administration has got has led to some concerns that probably the new administration might be more aggressive on tariff and on immigration, as well as on the fiscal policy, which may lead to higher inflation, higher borrowing, as well as then it may cut short the Federal Reserve easing cycle as well. So first things first, we really see that how the earlier tariff regime affected the economy. So as we know, so US follows a 4-year election calendar. In 2016, they had the election where Mr. Donald Trump was elected as the US president, which he served from 2017 to 2021. And as we can see, it was, again, expected that the tariffs will really change economic activity. It will lead to some slowdown and moderation in the rest of the world. So what we have presenting is this PMI's X of US. So that how did really rest of the world fared after the tariff imposition. And mind you, since President Trump took office in 2017, there was a time of negotiation, etc. So broadly, the tariffs were implemented in the end of 2017 and the early 18. And what we really see is quite interesting. In fact, manufacturing as well as services activity took off in 2017-18 because market participants, industries were anticipating some amount of tariffs, and hence they kind of preempted the move. And in fact, that whole kickstart in activity also benefited services. And in fact, it was a virtuous circle where mostly all the regions were benefiting from that preemption of the tariffs and preemption of the manufacturing sector. So yeah, so while on the face of it, it may look that the tariff regime may lead to some dislocations in manufacturing, the evidence suggests otherwise. And if you look at what really happened in manufacturing in ex of US in 2018-19, the decline, while yes, when the tariffs were announced, especially to China in 2018, that also coincided with the slowdown in Chinese real estate. So at the same time tariffs were kicking in, there was a large amount of correction which was happening in Chinese real estate, which led to this whole slowdown in China. And like we said, anything which happens in China also has a knock-on impact on the rest of the emerging markets, and that really led to the slowdown in manufacturing post 2018, and of course post-COVID. But largely services remained quite stable, as we can see from the chart. And given that a lot of correction has already happened in China on real estate, it really remains to be seen whether the current tariff regime, which people are expecting, will really have a meaningful impact on US manufacturing. In fact, as we can see on the blue line on the left-hand side, again, the manufacturing PMI has started to take off because, again, as the preemptive move to counter the tariffs, economies have started to build inventory, people have started to ship, and that's again kickstarting a new cycle of growth. Next slide. So if we look at how commodity prices are reacting, so if you look at especially in the last month, while we had increase in natural gas prices, they were offset by corrections in gold and oil prices as well. So if you would recall, gold prices had really run up before the US election as well as on Middle East escalation. But as things have stabilized, now we saw some profit booking in gold as well as in oil prices, as well as now people expect that at least the tensions in Middle East will be quite contained. And overall, we saw that commodity index hence remained quite stable. The opposite was seen in the food prices. So the FAO index was up 5.7% in the month of October, which was its 18-month high, driven by a spike in edible oil, dairy, and cereal prices. So as we have been also experiencing in India, the world has been undergoing some changing weather patterns, especially in Latin America, some parts of Europe, and other Southeast Asia as well. And these are the major manufacturing food hubs. And that's where these changing weather patterns had an impact on production of all these food classes. And that's where we are seeing the pickup in prices. It really remains to be seen whether next year patterns stabilize and we see upswing in food production. If we continue to see these kind of fluctuations, probably central banks will have to account for higher food prices, and that may change their easing cycle. But we've already seen a couple of years where food prices have seen a lot of volatility. So probably going forward, we should see some stability as now manufacturers, suppliers, and importers get used to the new cycle. Moving on, as we can see on the inflation side, global inflation readings have been quite well anchored. So if you look at the major economies, US, UK, Japan, Eurozone, or Canada, most of the inflation readings are now close to getting converged to around 2%. As we can see in the US, the last reading was 2.6. This month, which will be on 11th December, people are expecting about 2.7. So broadly, in US inflation is stabilizing around 2.5. As we can see for most of the economies, it's there, and which has led to central banks normalizing, their interest rates. What will really take central banks to go to take their interest rates back to pre-COVID levels or back to 2%? Probably the service disinflation also. So as we saw in the first slide, that the service economy continues to be quite robust and service inflation is on the higher side, and hence we are not really seeing inflation going back below 2. And if inflation continues to be slightly above 2, that's probably will take some time for central banks to really get comfortable for interest rates to go back to pre-COVID levels. And hence we expect that, yes, it's a normalization path that most of the advanced economy central banks will be taking. They hiked very aggressively during the 2022-23 rate hikes cycle. So they will normalize, but at least for now, it's very unlikely that interest rates in the developed world will go back to pre-COVID levels. Probably for Eurozone because they are experiencing a very sharp slowdown. But for rest of the world, we do expect that interest rates will be slightly higher. In fact, it's the opposite for Japan, where Japan is talking of rate hikes because for them, inflation is still quite above 2%. For them, for their historical perspective, it's quite negative. So that's the kind of divergence we are seeing in the advanced economies right now. So that's largely the snapshot of how global bond yields behaved. As we can see, for most of the economies, there was a correction or a rally in bond yields, apart from Brazil, which of course is talking of rate hikes because of inflation and slightly higher fiscal. But for most of the other economies, what really happened was in the month of October, there was a kind of 40 to 50 basis move across the curve, across regions. Of course, in most of the advanced economies where there were expectations that probably central banks will abandon their easing much faster than what earlier was expected because of high fiscal and political risk in the US, etc. So as there was stability in the US post the election results, market participants kind of recalibrated their stance that probably things will not be as bad as they were fearing earlier. Of course, and also political stability helps, and that's largely what we saw across advanced economy yields. If you look at the financial conditions, especially if you look at the credit spreads, the global credit spreads, they continue to be quite tight. Global equities continue to also be on the higher side, and hence we are seeing that financial conditions are still remaining quite loose. The interesting part of the chart is if you look at the right-hand side, this is the market implied policy rate forecast based on 1-year swap curve. And as we can see, compared to September, the swap curve is almost up about 50 basis points. So what really it signifies is that earlier market participants were expecting about 125 basis rate cuts from the end of December 24 till December 25. And now that rate cut expectations have been scaled back, it's now just 75 basis, that as market participants now expect that the tax cuts which will be announced by the new administration in the US will, one, lead to higher fiscal, and of course will lead to probably higher growth as well, which will probably reduce the need for Federal Reserve to cut rates so aggressively. So that interest rate calibration has happened. Bond yields have also adjusted. So any surprise on inflation side or on the growth side can again lead to this recalibration, and again those policy rate forecast can go for adjustment as we have seen throughout this year. So now coming really to the domestic side, and one of the most important updates in this presentation, which is the RBI policy, which went by on 6th of December. So largely, like Sonal said in the beginning, so the RBI kept the policy rate unchanged at 6.5%. The MPC voted 4:2 to keep rates unchanged. So compared to 5:1 voting pattern in the October, now the voting pattern shifted to 4:2, where two external members, Dr. Nagesh Kumar and Professor Ram Singh, voted for rate cuts. So basically, it shows the increasing shift towards growth support as well in the MPC. If you compare to the October policy, all 6 members voted unanimously to maintain the neutral stance. While CRR is not a MPC decision, it's a RBI's decision. The RBI decided to cut the cash reserve ratio at 50 basis points. Mind you, in 2022, when RBI had embarked upon rate hiking cycle, at that point of time, they had hiked the CRR from 4% to 4.5, which they yesterday normalized. So what does it really mean for markets and why did it do that? So just to again put things in perspective, in October, they decided to change the stance to neutral. At that point of time, market was not really expecting RBI to really change the stance. So what really went behind the change in stance? So if you look at when RBI changed the stance in October, there were very high geopolitical tensions in the Middle East, which had led to crude prices going up quite meaningfully from $70 to $80 almost. At that point of time, China had also announced fiscal and monetary measures in September, which had led to other commodity prices also going up. And thirdly, there were geopolitical risk in terms of US elections. So there were some headwinds in terms of currency as well. But despite all of that, RBI decided to change stance and to build that optionality that in case growth considerations lead RBI to, let's say, cut policy rates or do something on liquidity, that stance should allow them. So what it really meant, that stance change, was that RBI in a way was implicitly acknowledging that growth considerations also matter, and they were also probably seeing a growth slowdown going forward, and they were also seeing inflation stabilizing close to their target levels. As we can see, during the policy, they had revised their Q3 inflation forecast from 4.7 to 4.8, but they had retained their FY25 average inflation to 4.5. If we look at how things have changed in December policy, so like we had explained previously, one, the change in the US administration has led to expectations of a shorter monetary easing cycle from the US Federal Reserve. And it's also led market participants pricing up probably slightly stronger global growth and global inflation dynamics as well. It has also led to large amount of FPI outflow from India, in which RBI had to actively intervene in FX market, which also led to liquidity declining in the banking system. So if you look at from the liquidity perspective, the headline liquidity plus the government cash balance, which is basically core liquidity, was around 4.5 lakh crores in September, which fell to about 1 lakh crores at the end of November. So we saw a 3.5 lakh crores decline in liquidity because of FPI outflows, RBI intervention, and of course, because of seasonal currency leakage, which typically takes place in the second half of fiscal year. It starts with the festival season, and as the economic activity, rural economic activity picks up, typically we see currency leakage from the banking system. So we saw change in global interest rate dynamics. We saw huge decline in liquidity as well. On the domestic inflation growth dynamic front, what we saw on really inflation was that October inflation came at about 6.2%, whereas the growth for Q2 FY25 came about 5.4%, which was against the consensus estimate of 6.5 and RBI's estimate of 7%. So that really led market to to kind of revise the growth forecast for the remaining part of FY25 as well, and even for FY26. So overall, the best course of action for RBI was to probably do something on liquidity. It would have been very unlikely that in a policy where RBI is revising up its inflation forecast, they are going for a rate cut. So the expectations of the market was that RBI will probably do something on liquidity. They might not be able to do something on rates at this point of time. But even on the liquidity, while CRR cut was one possibility, CRR being a blunt tool as it straight away releases liquidity into the banking system, there was a debate between market participants that probably we may not see a CRR cut, we may see some other measures like longer term BRRs, etc., which will infuse some liquidity, but will probably not be durable. So we believe that action, if we look at the RBI's action with change of stance in October and the CRR cut in December, it's quite positive. So from an interest rate perspective, it reflects that they are confident on inflation. It reflects that they're also acknowledging that the growth is softening and they need to keep liquidity on the neutral side and interest rates on the lower side to kind of support the growth dynamics as well. We believe that once RBI has a better line of sight on disinflation, which they will probably have by the Fed policy, there is a strong chance of a rate cut in the Fed policy. Looking at the how inflation is really panning out. So like we said in the previous slide, domestic headline inflation moved to 6.2% in the month of October, compared to market expectations of somewhere close to about 5.5%. If we look at CPI diffusion index, where we weigh the constituents who have an inflation of more than 5%, it's not materially high. So like we can see, so broadly, what's really the reason behind this huge uptick? The reason again is food inflation. So as we can see, food inflation moved to about 9.7% YOY as unseasonal rains in the month of September led to pick up in some key vegetable prices, which really led to high inflation. So we look at the core inflation, which is the red line, that will still remain at a modest 3.8%. So broadly, core inflation remains quite stable. If you look at the diffusion index, which basically describes the breadth of items which are experiencing high inflation, that also continues to be on the lower side. So what really matters for inflation is your food inflation. And if you look at the outlook for food inflation, with rains turning out to be 8% above normal, your moisture levels in the soil are quite good. If you look at reservoir levels, they are quite strong, and hence it overall bodes well for your Rabi crop and overall your food prices in the upcoming season. And once probably RBI has better clarity on food prices, they continue to see a high frequency on the growth indicators, slightly on the softer side, it builds case for a rate cut in the month of February. So we talked about GDP growth, that GDP growth came at 5.4% compared to market consensus estimate of 6.5 and RBI's estimate of 7%. So what really went wrong? So if you look at, both from the expenditure side or on the, production side, large part of really the slowdown, if you look at on the right-hand side, came from manufacturing and industry. So as we can see, the industry growth, which was about 14.3% in Q2 FY24, fell to 2.2%. So of course, it was driven by a large statistical base effect as well, because the manufacturing sector was benefiting quite significantly from in FY24. So that base effect played out. One of the reasons why this number of 14% was there in Q2 was that typically how GDP is calculated is you calculate the nominal GDP, and from that you subtract the inflation to get to the real GDP. So what really happened last year was, because of your commodity prices were in decline last year, your WPI or your GDP deflator was negative. So on the nominal number, you added the negative deflator. So basically, you ended up with a higher manufacturing growth number. This year, because of the base last year, the deflator was positive. So again, because of from a negative deflator going into positive, we also saw some impact on the base effect, and it affected largely the manufacturing space. The second reason why we saw decline in manufacturing was we saw operating margins of corporates also declining this quarter. So as we could recall, last year at the same time, because of fall in commodity prices, many corporates experienced very high margins, which got reversed this year. and that's the other reason why we saw decline in manufacturing. The other area where GDP took a hit was, if you can see, mining and electricity. So we were talking about how the unseasonal rainfall impacted food prices. So the same unseasonal rainfall led to lower electricity demand as well, which led to electricity component of GDP going from 10.5 to 3.3. And also because of those unseasonal rains, even the mining activity was affected. So there was a slowdown in mining activities, which went from 11.1 to minus 0.1. But we do expect those unseasonal patterns have stabilized. So we do expect the mining as well as electricity to stabilize. Of course, manufacturing will take some time, but it should normalize back to its trend rather than this sharp decline. If you look at on the expenditure side, while yes, if you look at government final consumption expenditure or government spending, it fell from 14% to 4.4%. So as we saw that post elections, there was a slowdown in government spending as the new government was being formed, projects were being approved, etc. So while government spending has picked up, but it was still lower in terms of run rate compared to the same quarter last year. So we do expect that given that government has set a very ambitious capex target, the spending should pick up in Q3 and Q4 of FY25, which should lift the growth in H2 of FY25. But nonetheless, it may not be as strong as some market participants were expecting in the beginning of this fiscal year. So probably even RBI's current forecast may get readjusted when they meet for the next policy in February. So broadly, the growth outcome will depend really on how commodity prices pan out. So that really impacts corporate margins. So higher the margins, higher the GV and the GDP. It also impacts urban consumption. So what's really happened is, as RBI has tightened lending standards for banks and NBFCs, it has led to reduction in unsecured lending, and that's kind of had an impact on on the demand for consumer durables, etc., which is also impacted your final, especially the urban expenditure. So that really we'll have to see how the income growth and wage growth evolve in the next half to really see the impact on consumption. And of course, we are expecting government spending to pick up, which should lead to some moderate growth in the near term. So it should improve from the 5.5 levels that we are seeing right now, but it may not go all the way back to 7% unless and until something drastically changes, like I said, on either commodity prices or on relaxation of lending standards, which should boost urban consumption in the near term. So on the system liquidity, like we explained, as we can see from the chart, system liquidity has been quite surplus for a long time, but it had substantially declined in the month of November. Because of overall currency leakage and FX intervention. So it's moved to 1 lakh crores right now. RBI's reduction of 50 basis in CRR will again inject about 1.16 lakhs crores. But the interesting aspect is that it may not be enough. So by the end of January, we may again go back to a liquidity which will just be close to zero if the current trend of seasonal currency leakage as well as FX interventions continue. So unless and until the BOP situation reverses, where India continues to see high FPI inflows rather than outflows, other than that, we probably may see continuous decline in liquidity. So at some point of time, RBI may have to do other measures in January or February to again improve liquidity in line with their monetary policy stance. Those measures could be CRR cut as well, but that's very unlikely because if you see since 2013, the RBI has kept the CRR at 4%. So it's likely that they do not touch the CRR. They may do an incremental CRR cut, which will be a CRR cut only for a very small window of time, just like they did the CRR hike at the time of denotification of rupees 2,000 notes last year. They may do OMO bond purchases, which will be quite constructive for a longer end, or they may do FX buy-sell swap, which may impact the money market or the short end of the yield curve, but may not impact the long end in a meaningful way. So RBI has a lot of options on the table. The kind of instrument they choose will, of course, also determine what kind of yield curve outperforms at that point of time. So that's something which the market participants will be keenly awaiting in the months of February and March. So as we talked about how the reduction in unsecured lending has led to decline in urban consumption. This is a chart of non-food credit growth and deposit growth. And as we can see, retail loan growth is moderating. So it's from 16.4%, now it's gone to 15.8%. And within retail, if you look at unsecured loan growth, that's now moderated from 13% to 12.3%. So basically, the unsecured loan growth has seen a sharper decline, which is also impeding on consumption. But broadly, from a macroeconomic perspective, from a long-term macro-prudential perspective, we view this as constructive for the financial sector, as probably where this is one area where banks or the lenders do not know the end use of loans. So if this kind of area is seeing some moderation, that's probably more constructive for this sector from a long term, especially from a fixed income perspective. So if we look at the fiscal trends, we talked about how the government's spending moderation had led to decline in Q2 GDP. So it's very good to see that government spending has really picked up. So if you look at the fiscal deficit during April to October, that has now gone up to 46.5% of budgeted estimate. At the same time last year, fiscal deficit was 45% of the budgeted estimate. So broadly, the reason is that the center has transferred double tranche of devolution to states, which has led to shooting up in revenue expenditure, and also it has given that fiscal space to states to spend more aggressively, and that should have a multiplier impact in the near term. Capex continues to be lagging behind because, like we said, after the formation of the government is still in process of approving new projects and money is flowing there in due course. But on the other hand, your road and rail capex continues to be quite strong. But broadly, if you look at the fiscal position, we do expect that overall borrowing will be within budget estimates, and that's also supportive towards long-term bond yields. If you look at the trade deficit, so while the trade deficit had improved in the month of September, it again widened in the month of October to 27 billion, while the net services surplus also improved to 17 billion. One of the reasons, if you see behind the widening of this deficit from 21 to 27 billion, so if you look at the oil imports, they went up sharply from 12.5 billion to 18.3 billion, largely on account of festival-related demand. And if you look at the gold imports as well, they moved from 4.4 to 7.1 billion. So if you look at the whole, the 7 billion odd, widening of trade deficit, that can just be explained by oil and gold imports, and that was largely, we believe, due to festival-related demand. So as the demand will move away, topically, we do expect the trade deficit to become more sustainable and to go back to the trend levels. If you look at the export growth, that's very heartening, especially in case of non-oil exports. That's really gone up substantially from 29.9 billion to 34.6 billion. So that is overall quite constructive from a FX space as well. So we talked about what would be the impact of change of US administration on the world on the first slide. Now we are discussing the impact of change on US administration on India. So as we saw that during the earlier tariff regime also, it in fact had a opposite impact on the rest of the world. Probably in India also, as we saw, while it did have some impact marginally during 2018 and 19, but broadly it did not really lead to any material change in our in the way India was growing. If you see largely the degrowth which happened in December 19, where GDP 12-month average fell to 4.6% from 7.3%. It was largely due to the instability in the financial sector, where we saw one of the large non-banking financial companies defaulting and getting downgraded to D. There were some issues in a housing finance company and also in a private sector bank, which led to a lot of uncertainty and a lot of tightening of micro, prudential norms, as well as tightening in lending standards, which really led to this degrowth. But if you look at broadly overall, except this period where we saw some decline in growth, overall India continued to grow quite well. In fact, when the tariffs which were hiked in 2017, India grew by about 7.3% in 12 months rolling average in 2018. So broadly, if we look at the current position as of now, if we look at weighted average tariffs imposed by India on its imports from the US, it's about 15.3. If you look at the US, the weighted average tariffs is just 3.8. So probably, yes, India could be in the eyes of the new administration. Probably the new administration may decide to hike tariffs to, let's say, 10% or probably even 15% if it's really aggressive. If they want to match the tariffs which India has imposed. If you look at, US is a very significant trading partner for India. But what would really matter for India is not just the tariffs which are announced on India. What will really matter is what are the tariffs which are announced on the rest of the world. Because ultimately it's a relative game. If the tariffs announced on the rest of the world are much higher than India, then probably India will not be in such a weak position. So as we know, there are other countries which are very high exporter of manufactured goods to the US, such as Mexico, Canada, Vietnam, China, etc., where the new administration has talked about levying very heavy tariffs. And probably India may not be in such a weak position, even if, let's say, tariffs are hiked from the current 3.8% to even to 10% or 15%. Yes, of course, there could be impact of growth from 30 basis to 50 basis point, depending on the tariffs which are put on India. But given that India is a large exporter of services to US rather than manufactured goods only, probably the impact on India will not be very high. There is a concern that probably because of immigration norms being tightened by the new administration, India may see some decline in service exports. We really need to see that because like we said in the previous webinar also, in 2021-22, when the world was suffering from COVID, there was zero travel or very restricted travel at that point of time. In fact, we saw a large movement of global capability centers shifting away from the US to India, which led to large employment opportunities in India and also pick up in our service exports. So we really need to see whether really immigration has an impact on Indian service exports. As of now, we don't really expect too much of an impact on tariffs to India as long as they are levied elsewhere as well. Given that we export services majorly to the US compared to the goods, we expect a very minimal impact on for India for now. We believe that RBI's focus or RBI's policy trajectory will depend more on growth, inflation dynamics locally than what's happening in the US, barring any exceptional volatility. So of course, if geopolitical tensions really ratchet up and it leads to very high FX volatility, probably RBI may take a step back or they may delay. But we think as things are going right now, we do not really expect any material change in RBI policy for now. So as we saw during November month, overall, most of the yield curve shifted downwards, especially from 1 year space. As we can see in the shortened space from 3 months to 1 year, yields hardened slightly, reflecting the decline in liquidity that we talked about. As now with the CRR cut, that curve has started to normalize. If we look at overall shape of the curve and rates across 1, 3, 5, and 10 year, broadly, as we can see, both in the AAA or on the GSEC side, yields were down in the month of November, as market participants were expecting, some easing by RBI, either on liquidity or on rate side. So broadly, again, from the outlook, that if you really look at from a medium-term perspective, your global growth momentum is slimming. Like we discussed during our discussion on inflation, majority of inflation, driver in India is your food inflation, and that should start to slow down as overall monsoon has been quite favorable, reservoir level is quite strong, the soil moisture is quite strong. So overall, we do expect food inflation to come down in next 3 months. If you look at core inflation, that remains quite benign. So broadly, easing food inflation and the moderation in growth that we are seeing should open up space for 50 to 75 basis rate cuts in the current monetary cycle. If you look at, we are already in midst of a monetary easing cycle. Like I said, in October, we had the change of stance. In December policy, we had the CR cut. So the next logical sequence from RBI should be more liquidity measures, or at least a rate cut in the next 3 to 6 months. So what is the kind of products which make sense in this market environment? We believe that the moderate duration products, which typically maintain duration between 0 to 4 years, are best suited for investors, because this is a shallow rate cut cycle. So investors who have a investment horizon of 6 to 12 months can consider low duration and money market strategies, whereas investors who have a more than 12-month investment horizon and their tolerance for mark-to-market volatility is slightly higher can consider moderate duration, strategies like short-term fund, corporate bond fund, etc., which can benefit from reasonably high accrual as well as some potential of mark-to-market capital gains from here on. So that was it from my side. We can open the floor to questions. Thanks a lot for listening, and thank you.
Thank you, Anurag, for your insightful presentation and outlook on the fixed income markets. The webinar is now open for questions and answers. Like I said, you can continue to share your questions on the link provided to you if you have not already. While I wait for the questions to queue up, let me begin with the questions that we have already received. My first question is, RBI cut CRR by 50 bips to infuse liquidity into the system. Do you think this is sufficient? What, in your view, are the further actions that RBI should take to support system liquidity? And in this slide, what is your view on the interest rates in the near and the medium term?
Right. So if you look at the current core liquidity position, it's about rupees 1 lakh crores surplus at the end of November. So if we consider the trajectory of typical currency leakage, which happens between the month of December to March, plus we assume some intervention as well, given the current outflow situation, we are likely to see liquidity being in deficit probably by mid of February. So, and if RBI does nothing, no action from February to March, probably we may see liquidity deficit going close to 1.5 lakh crores, probably by Feb-March. So we do expect RBI to take some measures on liquidity, because if you look at the RBI's liquidity framework, typically they prefer slightly surplus liquidity in a neutral stance. They prefer reasonably high liquidity when they are in an accommodative stance, and they are comfortable with a slightly negative liquidity when they are in a withdrawal of accommodation stance. So given that they are in a neutral monetary policy stance, we do expect that RBI may take measures to infuse liquidity to ensure that the liquidity stays close to neutral or a slightly positive range. The measures that they can take to infuse liquidity is going for one more round of CRR cut, which we think is unlikely given that they have maintained CRR at around 4% since 2013. Probably what they can do is they can go for a ICRR cut, which just like I explained, that when there was a denotification of rupees 2000 note, and suddenly there was a spike in banking system liquidity, they hiked the CRR, but for a temporary period of time. So probably, given that February and March is a period of tight liquidity, they can cut CRR, but for a temporary period of time, and which can go back to a normal level once the government spending starts in April. If that were to happen, probably the short end of the yield curve may be more benefited than the long end. The other way where RBI can infuse liquidity is by doing open market bond purchases or OMO, which may benefit the long end of the yield curve more than the short end, because as the RBI will buy back duration of the market, it may lead to rally in the longer end of the yield curve. The other measure which RBI could take, and of course this measure list is not really exhaustive, and as RBI can always introduce new measures, is FX swap, where they sell dollars in cash and buy in swaps, which basically infuses liquidity in the market and is really neutral from an FX perspective, again, which is more constructive from the short end of the yield curve. So these are some of the measures which we think RBI can take potentially. Largely, the choice of measure would really impact the corresponding end of the yield curve. Like I said, any measure on the FX side or on the CRR side may benefit the short end. Any measure probably on the OMO side may benefit the long end. But broadly, I think by doing a CRR cut right now, RBI has demonstrated that they are serious about liquidity, that they are likely to take steps to ensure that liquidity is comfortable in the banking system.
The next question is, Indian rupee is at record low against US dollar. What implications of the weakening INR do you foresee on India's CAD?
So while it's true that rupee has depreciated against US dollar, if we look at relatively, compared to other emerging market currencies, most of the emerging market currencies have depreciated against dollar because of concerns of tariff, and the second concern being that probably Federal Reserve may not cut as aggressively as market participants were expecting before the new US election results. So we think if you look at rupee in that context, it's actually outperformed most of the emerging market currencies. The issue in really, from a CAD perspective, we are not really seeing any major impact on from CAD from a rupee perspective, where I think market participants are concerned is not trade balance, but from a balance of payment, which basically means that the FPI outflows that we have seen from equity markets in the month of October and November, that's something which market participants are watching out for. And if it continues, probably, as people move away from emerging markets back to the US, that's something which market participants are watching out for, and that may lead to more intervention from RBI. And again, it may have impact on liquidity, which they will have to address at some point of time. But from a macro stability perspective, our FX reserves are still quite reasonably high. So from a debt sustainability, external debt sustainability perspective, we are still on quite a strong footing if we compare it to other emerging markets.
Anurag, the next question goes like, RBI has projected inflation at 5.7% for Q3 and 4.5% for Q4, both of which exceed its target inflation level. What are your thoughts on this outlook, and how might it influence fixed income markets moving forward?
So RBI broadly has, expects that at some point of time, we are likely to see disinflation in food prices as winter sets in. As typically in every winter, we see correction in fruits and vegetable prices, and that should lead to disinflation in the January to March quarter. If that really view plays out, which most of the market participants are expecting, probably RBI will be in a stronger position to cut policy rates in the month of February, and from there on, we are expecting 50 to 75 basis of rate cuts once RBI has stronger evidence of that food disinflation.
The next question is, RBI has increased FCNR deposit rates by around 400 bips to attract foreign investors. What potential implications do you foresee as a result of this move?
So if you look at the current interest rates of many of the banks in FCNR deposits, they are even below the current ceiling. So it really depends on the banks to use that window and to offer those deposits. So it gives banks a flexibility, probably to get more dollar flows if they desire. But for now, we don't see it really having a meaningful impact.
What is your view on the slowdown of Q2 GDP growth to 5.4% from 6.7% in Q1 and uptick in November retail inflation numbers beyond 6%?
So like we discussed in the growth, when we were discussing growth outlook, largely it's driven by your manufacturing, which has been affected by base effects, and your decline in government spending, which was due to, as after elections, due to government was being formed and new projects were being approved. So we think that, as government spending should pick up in the next 4 odd months, and we should see the benefit of that coming in the Q3 and Q4 FY25 GDP. From an inflation perspective, like we again discussed, that largely the spike in inflation to 6% plus was due to, again, food inflation, especially vegetable price inflation. So as that vegetable price inflation comes down in the months of December, January, as winter sets in, that inflation should also normalize.
Sure. The next question is, since the last MPC meeting, India has experienced substantial outflows from FPIs, which have also impacted forex reserves. What is your outlook on this trend going forward?
So there have been outflows in India on two reasons. One, some allocation or reallocation to other emerging markets, which have taken more stimulus measures on fiscal or monetary side. There has been some reallocation from India back to the US because the growth outlook on the US is slightly more upbeat right now. As far as foreign or future inflows or outflows, it's really a function of relatively which economy is expected to do better. So if you really see FPI flows in the last 20 years in India, as Indian economy has done relatively well in the EM space, as Indian policy making has become quite predictable and stable, foreign flows have continued to really come into India at quite a rapid pace. So we do expect nothing has materially changed for India from a more medium-term perspective. So we do expect that India should continue to see allocation in the EM space. Of course, it's a matter of timing, whether they get those flows in the next 3 months or the next 1 year. But overall, from a medium-term perspective, India still continues to be quite an attractive investment opportunity for foreign investors.
Rest of time, I will take 2 more questions. While a bit of it you have covered also in your initial talk, RBI had maintained policy rate for the 11th consecutive instance and cuts cash reserve ratio by 50 bps this time for the first time since March 2020. However, question remains on when the RBI will pivot to cutting interest rates, especially in the face of slowing GDP growth and persistently high inflation.
So we believe that RBI has already moved to a neutral stance. RBI has cut CRR, which is a much more powerful tool than even an interest rate cut. We think that once RBI has greater visibility and greater confidence on the disinflation, which they will probably get in the next 3 to 6 months. We should start seeing rate cuts soon. So we are expecting a rate cut in the Fed policy because we think by that point of time, probably RBI will get even more evidence that the moderation in growth is still there. And of course, on the inflation side also, we should see some relief, especially on the food inflationary front. So probably we expect February to be uh, the policy where RBI initiates rate cuts. Having said that, we do expect this cycle to be a very shallow cycle, as we don't really expect uh, growth to really fall meaningfully, below 6.5 in the near term. And also, we do expect inflation to stabilize close to RBI's target. So unless and until you see a major decline in growth, we are likely to see a shallow rate cut cycle.
A follow-up question on this and the last question for today. If rate cut expectations materializes in Feb, which part of the curve do you think will be benefited most because of this?
Right. So if you look at the shape of the curve, today the 10-year bond yield is trading around 6.7 to 6.75. The 10-year corporate bond is trading around somewhere around 7.1 to 7.15. But if you look at the 3 to 5 year AAA part of the curve, that's trading around 7.5% thereabouts. So if you look at from a risk reward perspective, as any investment should be looked at whenever we are undertaking any new investment, that what's really my risk and what's really my reward. The risk is the rate cut cycle gets further stretched out, so that the expectation is that rate cuts may start in the next 3 to 6 months. It may happen that rate cuts slightly get elongated because the disinflation process is still slightly slow. So what really happens on the alternates that we are seeing, where on one hand you are probably earning approval of less than 7%. If you are in a segment of 3 to 5 year, your accrual is still reasonably high at 7.5%. On the second part, what's really priced in on the yield? As most of the market participants are expecting a 50 to 75 basis of rate cuts in the monetary policy cycle, a large part of that rate cut is already priced in on the long end, whether you look at the corporate bond or you look at the government bond curve. Where it's really not priced in is the 3 to 5 year space, because it actually has to see rate cuts to see that change in the overnight rates, and then it basically percolates into the corporate bond, short to medium end of the yield curve. So if you look at probably a relatively better opportunity lies in the 3 to 5 year corporate bond space than in the 10-year or the longer bond space, because a lot of positives are already priced in on that part of the curve.
Thank you, Anurag. On behalf of UTI Mutual Fund, I convey our sincere thanks to our viewers for actively participating in today's webinar and asking questions. Please share your feedback on the link provided. Post closing remarks from Anurag, we can conclude today's webinar. Thank you. Good day.
So thanks a lot to our investors and to our viewers to attend this session. We'll of course meet in the next calendar year. So wishing you a very happy holidays and a very happy new year in advance. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.